Growth versus value. Stickman's investment style. John is standing on the roof of his headquarters, looking out over the city skyline. Below him, the factory he built is humming with activity, and his stock, STCK, is trading steadily on the exchange. But as John looks at the financial news, he sees his company categorized in a way he hadn't considered before. Some analysts call Stickman Keyboards a value stock, while others insist it is a growth stock. John realizes that to steer his company into the future and to help his investors understand what they are buying, he needs to master the final piece of the valuation puzzle, the difference between what a company is today and what it could be tomorrow. As Brealey, Myers, and Marcus explain, the value of a firm can be split into two distinct parts. The first part is the value of assets in place. This represents the present value of the cash flows that John's current factory and current keyboard models will produce if he never grows another inch. It's the safe part of the business, the machines, the existing patents, and the loyal customers he already has. If John decided to stop innovating and simply pay out all his earnings as dividends, his stock price would reflect only these assets in place. But John isn't interested in standing still. He has plans for augmented reality interfaces and MindLink typing technology. This leads to the second part of the valuation, the present value of growth opportunities, or PVGO. PVGO is the extra value that investors build into a stock price because they expect the company to reinvest its earnings into profitable new projects in the future. For a company like John's, the stock price is actually stock price equals value of assets in place plus PVGO. This distinction is what separates value investors from growth investors. John looks at a classic value company, perhaps an old utility company that provides electricity. They have massive assets in place, they pay high, steady dividends, but they don't have many new places to grow. Their PVGO is very small, and their stock price is mostly just the value of their existing business. On the other side of the spectrum are growth companies. These are the tech startups that might not even be making a profit yet. Their assets in place are almost zero, but their PVGO is massive because investors believe they will dominate the world in 10 years. John has to decide which path he wants to take. To fund his growth, John has to make a choice about his plowback ratio. This is the percentage of earnings that he keeps inside the company to reinvest in new projects rather than paying them out as dividends. If John plows back 60% of his earnings into the VR keyboard project, he is betting that the return on equity, ROE, of that project will be higher than the return his investors could get elsewhere. Brealey, Myers, and Marcus warn that growth isn't always good. If John reinvests money into a project that earns a return lower than what investors demand, he is actually destroying value. Just because a company is growing its sales doesn't mean it's increasing its stock price. True growth, the kind that boosts PVGO, only happens when the company invests in projects where the return is greater than the cost of capital. This is the golden rule that John must follow. John looks at his company's PE ratio, price to earnings. He notices that his PE is higher than the industry average. At first, he's worried, but then he remembers the lesson. A high PE ratio usually means the market is pricing in a lot of PVGO. It's a sign of confidence. Investors are willing to pay a high price for every dollar of current earnings because they expect those earnings to skyrocket in the future. A low PE, conversely, often indicates a value stock, a company that is stable but has limited room for explosive expansion. So, what is Stickman's investment style? John realizes he doesn't have to choose just one. He wants to build a value foundation with a growth engine. He wants his current keyboard line to be so efficient that it provides the steady cash flow, assets in place, needed to fund his wildest innovations, PVGO. He understands that as a manager, his job is to find the perfect balance. If he pays out too much in dividends, he starves his future. If he reinvests too much in bad projects, he wastes his shareholders' money. John steps back from the edge of the roof and heads back to his desk. He has a clear vision now. He will tell his investors that Stickman Keyboards is a growth company with a value heart. He will focus on high ROE projects that justify a high PVGO, ensuring that every dollar he plows back into the business comes back multiplied for his shareholders. By mastering the concepts of PVGO, plowback, and the PE ratio, John has completed his journey through the world of valuation. He no longer sees his company as a collection of parts or a ticker on a screen. He sees it as a dynamic engine that transforms today's capital into tomorrow's reality. He is a builder of value, an architect of growth, and a steward of the future. With the math of finance as his guide, John is ready to lead his empire into its next chapter, confident that he knows exactly how to create wealth that lasts.